Certainly a lot to be thinking about, as there always is, right? I mean, just this past week, we had headlines about the Fed raising interest rates. We had headlines about the economy for the second quarter. Actually, the number came in a little bit better than what folks expected. So that certainly gave some hope that maybe the Federal Reserve, fingers crossed, might be done raising interest rates. But certainly those higher interest rates have led to this big conversation about cash. And I remember probably 3 or 4 months ago really starting to kind of put my hands around that, and was sitting at home on a weekend, paying bills, balancing my checkbook, things like that. And yes, I still do balance my personal checkbook. You still balance your checkbook?
I do. Keep it in my briefcase every day. I look at it. It's a habit. All my life, that's what I did. So it's hard to change.
There's a register, you write it down, and then when you see it clear the bank, you put a little X by it, and
correct.
Then you do the math to confirm the balance. Right. Anyway, but I was doing that one weekend here, probably 3 or 4 months ago, and I kept looking at the amount of sort of as with most folks, we usually there's usually some extra amount in the checking or perhaps in the savings account, or at least we certainly hope there is for you. If there's not, then that's a different radio program that talks about how you establish an emergency savings fund. Go to our YouTube channel. You'll find that program there among the several hundred that are there already. But as I looked at it, and I looked at the fact that there was zero interest paying. And we've certainly talked about this. I think we talked about this at length on our June 11th program about how the banks really haven't, and they've started to do a little bit, but they really didn't change the interest rates sort of in lockstep with the higher interest rates that is prevalent in the markets as a whole these days. That's for sure.
Yeah, I mean, it's obviously the banks are very anxious to charge you a higher interest when they lend you money, but they haven't been as anxious to give you a higher interest return on your savings or anything that they offer. That
is certainly very much the case. And so we introduced that concept to our clients, and the response really has been overwhelming, because if you think about a cash account or a money market account, believe me, we get it. I mean, if you can have money that is sitting there that isn't generating, it doesn't have any risk or no volatility, you don't have to worry about the stock market, et cetera, and you're going to make 4.5%, maybe even close to 5% after this week's Federal Reserve interest rate increase, then, why not, right?
It's tempting, I understand.
The problem is that if we use history as our guide and we look at these peak levels of cash, it tells a very different story, doesn't it? So cash, as you were saying in the last segment, we've got a peak cash, and these are numbers as of the end of May, $5.4 trillion sitting in cash and cash equivalents. What were those previous numbers from days past?
Well, we knew that we hit kind of an all-time high in January of 2009, got up to 3.9 trillion. And at that point, that was tremendous. And then shortly, just a few years back, we hit 4.8 trillion in cash and cash equivalents accumulated by investors.
And the interesting thing about those dates, and we want to just take a moment and reiterate those dates that we're talking about, of when we have seen cash levels crest in over the course of the past 20 years. One of those dates, January 9th of 2009. So what was going on then?
Well, at the time, cash seemed very attractive, but shortly afterwards, the stock market had a nice little bump up and rally.
January was about the bottom of the markets for the financial crisis that was going on in 2008. The financial crisis of 2008, that was the one where a lot of people were losing their homes on a regular basis. That 2008 financial crisis sort of bottomed out in like March of 2009. So we see that cash level rising up dramatically around that period of time. And then the other date, May of 2020, well, that's COVID, right? And so the world's shutting down to COVID, a high degree of uncertainty. Both of those periods of time coincided when the markets were low. And the reality is then that we think that there may be another conclusion that investors might want to be drawing when it comes to cash and these cash levels, because the amount of cash may actually, the fact that it's peaking may actually send a different signal from an investing perspective.
Obviously, that's true. I mean, we can see why investors were so drawn to cash at this point.
Sure.
And, when COVID hit, people were nervous. Let's go to cash. 2008 was a tough year. People went to cash and they just loaded up. Right now, there's still people that think that the stock market is in peril when we've actually seen some great growth this year. So people have sit around in cash. And again, when interest rates are this attractive, they just put on their blinders and think, I'll take the simplest path. I'm going cash.
Yeah, I mean, I think it's important for our listeners to sort of think of it this way, right? If the world is moving to cash at record levels, what does that mean? What typically occurs when we have seen that happen in the past? The world moving to record high cash levels, do you think that occurs when the market's really up or when the market's down? Do we think that occurs when fear is high or when everything is sunshine and roses? History certainly tells us, if we look at those prior cash level peaks, that maybe when cash levels are high, then that's actually not a bad time to be thinking about investing money, right? Isn't the whole concept that we want to buy low and sell high and not the other way around?
That is correct. And if you look at what's going on today, we've hit this $5.4 trillion of cash equivalents, and the market has already kind of bottomed out and it's making its way back up. History repeats itself, as we know. This is a perfect example of what's about to happen.
But here's always the struggle, right? Is we don't know tomorrow, right? We can certainly look at these numbers. We can certainly look at history. We can certainly think about what might be happening or what might have been some of the indicators of the signals in the past. But what makes sense? Because we don't know tomorrow. And clearly, from a cash perspective, you always want to have 6 months of emergency savings in. I mean, that goes, I guess, almost without saying, but there we've said it again, 6 months of emergency savings. And then to the extent that there's more, then it becomes potentially an opportunity to be thinking about investing the money beyond just having it sit in cash. And so what's our strategy for that, Rob? Because certainly we've been talking to a lot of folks about that over the course of the past couple of years, if you will.
Right. So we know that over time, the stock market is going to give you your best average annual return. We also know that moving into the stock market can be a concern. And so there's different ways to address that. We like to talk a lot about dollar cost averaging, which is simply saying we understand, we empathize with you that you don't want to just load all your money into the market. Signs tell us today, hey, we could be at a low, but let's slowly get in. So dollar cost averaging says we've got this amount of money earmarked that over time will be invested, but let's not dump it in at once. Let's come up with a systematic plan over time, 12 months, 18 months, to move this money slowly into the market. So with dollar cost averaging, we're just sort of committing to slowly get into a market that we know over time will hit an all-time high.
Because the market has a pretty good history of that. There's never been a time when the market hasn't fully recovered and gone on to set higher highs. Stop and think about what I just said for just a second. There's never been a time where the market hasn't gone on to fully recover and set higher highs. You can look through your history books to confirm that, but that is certainly the case. And so sitting in cash may very well not be a particularly good place. Don't misunderstand me. Always good to have cash when it comes to emergency savings. But at the end of the day, Rob, that dollar cost average strategy that you just described, that's an oldie but a goodie.
Right.
Okay, been around forever.
There's three things that occur if you dollar cost average. One's going to be you're slowly moving the money. Well, we'll kind of we'll talk a little more about that next segment. I'll wrap it up real quick.
Well, that's important, but there's three things there to really consider, which we're going to talk about a little bit more when we return after the break here on Dollars and Cents with Joel Garris and Rob Field of Nelson Financial Planning.